Welcome back. You're watching Stock Watch, and joining me to unpack your stock-related questions this afternoon is Crail from FNB Wealth and Investments. Do send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, Nick. Of course, it is a Friday Stockwatch, so we'll be going through some questions that have been sent through by the viewers, but also just a recap of some of the most notable company movements that happened during the week. Let's actually just start off with how you have perceived market movements today, particularly as we had that mixed economic data coming through with US inflation and all of that.
Yeah, so I think, if we have a look at the week in general, the biggest move has been around what's happened with US inflation. We unfortunately know that company releases are almost taking a bit of a back foot into directionality of where equity markets in general are going for the next year. A lot of it comes down to, the market anticipating that, number one, the US economy is going to remain pretty robust during the course of this year. Number two, we're going to see significant rate cuts happening as early as March. At least that was what the market was anticipating. And this in itself would fuel, I suppose, potential equity returns. And so even though in the US we've seen significant returns year to date, a lot of it is hinged on this idea that that inflation's under control, and, the Fed is going to start cutting rates. We then saw inflation coming out for January in the US that was above expectations, showing perhaps, wait a second, maybe we haven't exactly slayed this inflation beast as we sort of expected. And perhaps, the market is going to have higher rates for longer. In that, we saw a significant sell-off for a day.
Yeah, for a day.
So it's a bit crazy at the moment.
Yeah.
We have seen great returns, and the market did spook, but it really was for a short period of time. And, we're going to continue being in this economic environment, or this environment where we're all searching for the next data point with very low visibility as to exactly what the data point is going to be, whether inflation beats by 0.1% month on month or whether it misses. And you're going to see this volatility, I think, in the stock market overall. Our view largely has been that the market was a bit crazy expecting significant rate cuts this year. We do think that you are probably more on a higher for longer type of scenario. We're still expecting the US to cut rates this year, and South Africa as well for that matter. But we thought it would be somewhat slower and in a more orderly kind of fashion than what the market was anticipating. Yeah. And I think now the market is starting to reprice that. And, that's probably been one of the biggest market moving features and memorable things for what's actually happened during the course of this week.
Yeah. Nick, there is a viewer that sent in a question listing 12 ETFs. I'm not going to go into all of them, but I'll just, reference specific themes. And as we're talking about the, this higher for longer interest rate situation that we have at the moment, would you maybe be focusing on offshore stocks? For example, there's an ETF here that's listed, the Satrix MSCI World. Would that be an option?
Yeah, so I think certainly if we have a look from a South African perspective, economically we've struggled for the last decade. Our market remains cheap. I think the differential between emerging markets and, let's say, the US markets is at its weakest it's ever been. So really over the last decade, there's been one game in town, and that's been the US markets. Yeah. So in that, we've watched the Rand weaken as well. I think if you'd been invested overseas for the last 10 years, you've made great money. And if you've been invested in South Africa, it's been a tough time. So in that, we've also seen a lot of interest, I think, for international sort of investments. And certainly as a diversifier part of your portfolio, I'm not sure whether or not South Africa is going to outperform in the next decade. My feeling would be that we're cheap, but fundamentally a lot of the companies that are here are let's say, slightly more old school businesses, being mining, being banks, etc. They're a little bit less sexy and a less growth orientated than, let's say, the latest AI theme and thing that's going to take over the market. If you want to play those themes, you've got to be to be offshore. So I think getting some exposure offshore makes sense, even at these levels, even post all of these runoffs and run-ups. It's certainly a more interesting conversation because of the type of companies that one can get exposure to.
Well, talking about the sexy part of the market, there is a question here. Do you think there's still more upside for the US tech stocks, or is it time to take profits and go? Of course, there are also questions on a number of S&P 500 ETFs. Do you think there's still more upside? Yeah, let's actually start there. Do you think there is more upside, or do you just take your money and go?
No, so I'm certainly not in the scenario of taking your money and running.
Okay.
I am in the scenario of hopefully you invested aggressively a year and a bit ago.
Yeah.
You've now made significant returns. Now it's time to take some of those profits off the table. So, are you going to make 700% from NVIDIA in the next year? No, I don't think you are. Would I still have some exposure to NVIDIA in my portfolio? Yes. If I had none right now, would I still be buying some? Yes, but smaller and with much lower sort of expectations. So I don't think the returns have gone, but I think the easy money and the exponential type of money has really probably left the market, in which case, yeah, I'd much prefer to rotate some of those winners into areas of the market that are offering more value, but I wouldn't be selling out, because I don't think it's at ridiculous levels and valuations. I think momentum and interest can continue to push this higher.
Yeah. Nick, there are also questions about ETFs in India and in China. Of course, we've been exploring these different themes. For example, India, because of the economic dynamics there that are shifting, there's a lot of opportunities seen in that market. And then you have China, where it seems that it's kind of polarizing, because the stocks there are looking very cheap, but also, there's still those risks. Let's actually start off with India. Would you be investing in, for example, an ETF that is focused on India?
So my preference always is to understand what you're investing in a bit more. So I prefer investing in single stock counters and companies themselves. One of the problems you find in India is that it's a tough market to get access to. And the vast majority of companies, and the bigger companies, are massive conglomerates, where again you're almost buying like a mini unit trust as it sort of stands. They've got so many different areas of expertise and exposure into the different sort of areas of the Indian economy that it makes it quite difficult to understand exactly what the earnings are going to be. So in that, I think the structure is not optimal. I think it's still an early sort of development, and I think over time you're going to watch a lot of sort of value unlocked from unbundling of different, more focused type of companies in that environment. From an ETF kind of perspective, and because of the structure of the market, what you have is a lot of investors and investor interest, and all that's really happened there is that a lot of these companies are trading at significant multiples. So they are looking expensive, they're looking stretched, but it is one of the areas in town where you still know, on a multi-decade kind of view, there's a lot of opportunity in India. So, you can afford to maybe get in at these sort of expensive levels. And because of the structure of the market, an ETF is often quite a nice way to get exposure into that, where you can't get exposure into the exact sort of demographics that you want to within the Indian economy in a single stock kind of basis.
What about China?
But it is straight.
Yeah. What about China? Which side of the fence are you on there?
No, I'm more of a China bull than a bear, mainly on valuation. I think it is unbelievably inexpensive. Now, what's going to make it go cheaper from here? Well, it's going to be two things, and then it's your view on whether or not that happens. Yeah. One is that effectively, de facto, the US and the Western world goes to war with China. We almost get to that proper war sanction issue, uninvestable sort of from an international Western perspective. That'll drive it cheaper. One, you've got to think whether that's going to happen. The second being whether or not the idea of 100% socialism and communism is going to come to the fore, and the sort of mixed model of a little bit of capitalism combined with a lot of socialism, whether that is not going to be in the future. So if you think that regulation there is going to say all of these guys and rich people in general in China, you're not allowed to exist or be rich any longer, we're taking all your assets from you, then the market is obviously going to get cheaper. Now, if you don't have those two worst case kind of scenarios, and especially looking at its opportunity set and its valuation on a global basis, China is a massive opportunity.
Yeah.
When that unwinds, I'm not 100% sure, but certainly I'm more in the camp of continuing to increase my exposure to China in certain areas, and I'm willing to take that sort of risk because I think you're going to see outsized returns from China if you don't see those two worst case scenarios sort of take place.
Yeah, there's a very interesting one here, the Resi ETF, of course, concentration in the resource sector. Do you want that sort of concentration right now in that sector that's taken quite a beating?
Well, I mean, we touched on this a little bit earlier that in general, I think resources, number one, you have a very marginal ability to predict what price any of these, as a company, you cannot decide what price you're going to sell your good at.
Yeah.
Oh, sorry, my lights have gone off.
Yeah, it's okay. But we can still see you.
There we go.
We can still see you.
Okay, so you don't have your pricing power on that sort of side. Your ability to actually predict exactly where iron ore or oil is going to be in 5 years' time is very, very sort of remote. And you've got significant environmental concerns around actually, digging out natural resources of the world. So naturally, I would say that there's much more attractive areas of the market you'd want to be invested in, things where you have pricing power, where consumers or people want your services desperately, and you kind of can estimate a little bit easier what sort of margins and how you can protect your business. So I think it's a bit of an old school area of the market. Having said that, in South Africa, it makes up, let's call it 30% of our market and our index, so it is material, and it is largely pretty cheap at the moment, coming off significant sort of bases, but it's had a dramatically poor last 12 months. And so in that sort of environment, I think, especially in a South African context, it's not bad to start accumulating some resources exposure. Would I be overweight at the moment? No. Would I be even equal the market? No, I wouldn't. I prefer to put my capital elsewhere. I'm happy being underweight. But as things get cheaper, I don't think they go out of business. And therefore, in that sort of environment, you want to start taking nibble-sized bites here or there.
There's also a question on FNB ETF. And earlier on, you were also talking about, these parts of the markets that are not as sexy as the AI counters in the US. But is it not sexy, but attractive, right?
It is attractive at the moment. They are cheap. ROEs have generally gone up quite nicely. I think they're generally well managed. Balance sheets are in good position. Unfortunately, I think a lot of the potential growth vectors, because of the economic malaise that South Africa finds itself in, are somewhat more absent. So you're going to be a lot more correlated to how South African economy actually goes, opposed to finding better new growth ventures outside of economic growth. And because we're not doing particularly well, you kind of think, okay, maybe the growth is going to stabilize and is largely absent, looking forward. It's not going to be a growth stock, but you're still generating massive free cash flows. You're paying out decent dividend yields. Your balance sheet is strong. And in that environment, it's still remaining very attractively priced. So I think for banks to do really well, you've got to see some sort of demand from international investors to invest in emerging markets in general, but South Africa more specifically. And then I think we'll start getting back to that. You'll get that re-rating that'll make returns actually really good. But in the meantime, it's a defensive area to sort of stick some exposure in. It's your conservative area where you kind of think, well, nothing's really going to fall apart. It's not going to look sexy, as you said, but it's not going to fall apart. Pretty attractive.
Yeah. Well, a counter that was not looking sexy for a long time, but since we've heard of potential corporate movements there, MultiChoice has actually gone up quite a lot now, to the point where, because when Canal Plus actually came in and said that they want to buy out the rest of the shareholders, and it was trading at around 95 Rand, but now it's gone up to the same level as that price that Canal Plus has offered. What does Canal Plus do at this point?
I mean, who knows? The one thing that I found very interesting with all of that is, you're bound by a certain amount of regulation when it comes to media within South Africa. And I don't think Canal Plus had reached out to any regulators in any way, shape, or form. So there's some uncertainty as to just how the transaction would work. There's a lot of work that I think still needs to be done.
Yeah.
Does it make sense for MultiChoice investors and Crail Plus investors? I think overall the combined entity would be significantly stronger than the two parts as it stands at the moment. So I like that. As an investor, do I want to get bought out and get paid cash for it? Well, no. Preferably, I want to get some shares in this combined entity, so I prefer a different kind of structure. I think the share price move has been significant. I think the Crail Plus offer was good for shorter-term shareholders of MultiChoice, but overall would also offer enough upside, I think, for Crail Plus, into the future in a combined sort of entity. I think at the moment, with the levels of uncertainty around the offer, what the next steps actually are, regulation, etc., if I was a MultiChoice shareholder, I would consider exiting. And maybe it turns out that I exited too early. But the big threat here would be if this deal actually just falls away. MultiChoice are going through a tough period at the moment.
Yeah.
And I think it's expected they're going to go through a tough period for the next couple of years. So from that, if the deal falls away, I think that the stock goes backwards and goes backwards pretty quickly.
Yeah, that's the thing, because then we'll realize, there are actually still these challenges that the company has been dealing with no potential buyout offer. Let's get to your stock pick for today. Nick, what will it be?
You know what? It's a tough one, because I do find myself preferring probably international markets, even though I think the rand is slightly oversold. I think the international markets, the performance has really come through, and there's many different areas to skin it. The one at the moment I'm actually going to go for is NVIDIA, which I think is a weird choice, seeing as though it's up 700%. I think it's certainly an interesting pick in the sense that I think their results come out next Wednesday, and I think that, for me, is the big potential market mover of the week. If they come out with disappointing sort of results, I think you're going to see a large section of the market have a bit of a correction. Having said that, if they do what they've been doing, and that is sort of almost a beat and raise, I think the juice in the US market specifically, but this AI theme, is going to continue running. So very interested to see, and I think there's still value in NVIDIA if you haven't hold it, even at these sort of levels.
All right. Well, thank you so much for your time and for your analysis today, Nick. Really appreciate it. That was Nick Crail from FNB Wealth and Investments.